factor investing has become more and more popular over time, especially since the financial crisis, simply because investors realized that there is actually very little alpha, and most of it is just what you call systematic beta or factor exposure. Of course, investors do want to achieve outperformance. So if you're benchmarked against, let's say, the S&P 500, the S&P 500 is up 10%, it would be great if you're up 11%. Now, finding fund managers that generate that extra 1% that you want, that's actually quite challenging. Now, factors have shown over the long term, especially if you combine several factors, that they do allow you to basically outperform an index. And that's why they have increased in popularity. They're the only source of returns that do allow to outperform in an index. It doesn't matter which asset class. One way of explaining why factors works, why they should generate excess returns, is that they do represent risk. And you get effectively compensated for holding them, that once in a while actually that risk takes place in terms of drawdown, but over a long time you can harvest those returns. Factor investing comes from the academic world versus smart beta is the practical application. Smart beta is nothing than factor investing in a long-only form. So effectively what companies like a BlackRock or like a Vanguard do is to take the S&P 500 and they tilt it towards certain factors. So if someone wants to take advantage of the value factor, they can look for a smart beta value ETF. I think it's very important to note that there's a big discrepancy between theory and reality. So what most investors who are interested in factor investing do is they tend to read academic research, or at least read what other people are summarizing about academic research. So what you see is those returns being published in financial journals, let's say the value factor giving you X, Y, Z% return. Now, what unfortunately has happened is that if you take the investor products that most investors have access to, especially retail investors, in terms of smart beta ETFs, that the returns you get out of those are often a fraction of what you see in the academic journals. So there's a big disconnect between what people are reading and what people are getting. And that's something worth highlighting, that the opportunity set, what investors have, especially on the retail side, is just so much more narrow than what you have on the institution side, where indeed you can replicate structures that are more similar to what you read in academic research.